This week's episode will deep dive into 5 lesser-known number 1 daily percentage gainers with market caps between small to nano range for the trading week of March 24th to March 28th, 2025. Portage Biotech Inc. is a clinical-stage immuno-oncology company focused on advancing therapies that improve long-term treatment responses and enhance the quality of life for cancer patients. The company's approach is built on leveraging cutting-edge biological mechanisms to identify promising clinical therapies and accelerate them through development. With 4 key platforms in its portfolio, Portage's lead programs include invariant natural killer T-cell, iNKT, engagers, and a suite of treatments targeting the adenosine pathway, 2 approaches designed to reinvigorate the immune system's ability to fight cancer. Across these platforms, Portage has 9 product candidates, 5 in preclinical stages, and 4 already in clinical trials. Among its most notable candidates are its small molecule adenosine inhibitors, Port-6, Port-7, Port-8, and Port-9, which specifically target adenosine receptor pathways that play a role in immune suppression in tumors. Now, let's get into what's been happening with Portage recently, because there have been some major developments that investors need to pay attention to. This is a company that's at a pivotal moment, facing financial and strategic challenges, but also making significant moves to reposition itself for the future. If you've been tracking the biotech space, you know that clinical stage companies often go through waves of transformation, and right now, Portage is in the middle of a critical restructuring phase. One of the biggest recent challenges came in December 2024 when Portage received a non-compliance notice from Nasdaq. This was due to the company's shareholders' equity falling below the required minimum of $2.5 million. As of September 30th, Portage reported just $695,000 in shareholders' equity, which is a significant gap. In response, the company announced that it would submit a compliance plan by January 24th, 2025, detailing how it intends to regain compliance. This plan could involve securing new financing, exploring strategic alternatives like mergers or partnerships, or restructuring its operations to improve its financial standing. Now, when a company gets a Nasdaq non-compliance notice, it doesn't necessarily mean delisting is imminent, but it does put pressure on management to act quickly. Investors should be watching closely to see how Portage navigates this challenge. Will it secure additional funding? Will it enter into new strategic deals to bolster its balance sheet? These are the big questions that could impact the company's future. At the same time, Portage is also making some notable changes to its pipeline strategy. In a significant move, the company decided to discontinue its sponsored trial for the iNKT program and pause patient accrual for its AdPort 601 study, which involves the adenosine 2A inhibitor Port-6 and adenosine 2B inhibitor Port-7. This decision signals a clear shift in focus. Portage is reassessing its priorities and directing resources toward the programs it believes have the highest potential for success. While these types of decisions are never easy, they can be necessary for a small biotech company trying to optimize its chances of bringing a successful therapy to market. But here's where things get really interesting. Portage recently entered into a letter of intent, LOI, with Immunova LLC, which gives Immunova the option to acquire Iox Therapeutics, Limited, a wholly owned subsidiary of Portage that has been developing liposomal iNKT agonists, including the lead candidate Port-2. If this deal goes through, it could provide Portage with much-needed financial flexibility and allow it to narrow its focus to the adenosine pathway. This potential transaction is an important piece of the puzzle because it suggests that Portage is actively looking for ways to unlock the value of its assets while also ensuring that its most promising programs receive the attention they deserve. To further reinforce its focus on adenosine-targeting therapies, Portage made another major move in January 2025 by relaunching Syncato Therapeutics as a standalone subsidiary. Syncato will be entirely dedicated to developing adenosine receptor antagonists, and the company brought in Peter Malloy as CEO to lead the effort. His job? Secure financing, advance the clinical development of these therapeutics, and build a team that can take these assets to the next stage. This is a bold move because it suggests that Portage still sees strong potential in the adenosine pathway, but wants to structure its business in a way that allows for more focused development. So, what does all of this mean for investors? Well, Portage is clearly in transition. It's making big strategic decisions, facing financial challenges, and restructuring its pipeline to focus on its most valuable assets. The NASDAQ compliance issue is something that needs to be addressed quickly, and how management handles it will be critical in shaping the company's future. If Portage can secure financing or strike new strategic deals, it could regain stability and continue advancing its pipeline. But on the flip side, if it struggles to find a solution, there could be concerns about the company's long-term viability. One key takeaway from all of this is that Portage is being proactive. It's not just sitting back and waiting for things to play out. It's actively reshaping its business to put itself in a stronger position. Selling off non-core assets, streamlining operations, and refocusing on high-value programs are all moves that could ultimately benefit shareholders in the long run. But biotech investing is all about execution. The company has a vision, but can it deliver? For investors, the next few months will be crucial. Keep an eye on the NASDAQ compliance situation, whether Portage is able to meet the requirements or if it has to take alternative measures. Watch for any updates on the potential Immunova deal and how Syncado moves forward with its development plans. And, of course, pay attention to any financing announcements, as securing additional capital will be key to keeping the company on track. At the end of the day, Portage Biotech is in a make-or-break moment. It has promising assets, a clear strategic direction, and a management team that is actively working to navigate challenges. But biotech is a tough business, and success isn't guaranteed. The coming months will be defining for the company, and how it executes on its plans will ultimately determine its future in the immuno-oncology space. If you're following Portage, stay tuned because this story is far from over. Alright, let's dive deep into the latest happenings around Marblegate Acquisition Corporation because there's been quite a bit of movement lately, and if you're an investor, this is definitely something you'll want to keep an eye on. Now, for those of you who might be newer to the world of blank check companies, let's set the stage a bit. Marblegate Acquisition Corporation is what we call Special Purpose Acquisition Company, or SPAC. These are essentially shell companies set up with the sole purpose of raising capital through an initial public offering, IPO, with the idea that they'll eventually merge with or acquire a business that's looking to go public. SPACs don't have any operations at first, and they don't generate any revenue. They're just there to find a target company and make a deal. And Marblegate, well, it fits that mold perfectly. Until recently, it hadn't selected any specific business combination target, and it hadn't engaged in any substantive discussions with potential targets either. But that's where things are starting to get interesting. Marblegate has been setting the groundwork for a pretty big shift in its future. On March 25, 2025, a significant step was taken when the shareholders voted overwhelmingly to approve the merger with two entities, DePalma Acquisition I LLC and DePalma Acquisition II LLC. Now this is where the rubber meets the road because this vote was basically a green light for the company to pivot from being a typical SPAC to becoming a fully operational business, which is a big deal in the world of SPACs. So, if the vote passed, we're looking at Marblegate essentially rebranding itself into a new public entity, Marblegate Capital Corporation, and transitioning from just a SPAC to a real operating company with perpetual existence. That's a major change in structure, and it's all about setting up the company for long-term growth. Let's talk about how the shareholders felt about all of this. The meeting was pretty much a landslide, with over 82% of outstanding shares represented and more than 9.5 million votes in favor of the merger. That's pretty decisive, indicating that investors are feeling good about the direction Marblegate is headed. But it wasn't just the merger approval that stood out. Marblegate also managed to get approval for some major changes to its governing documents. The most important one? The increase in authorized capital stock from 221 million shares to 260 million shares, which could give the company more flexibility moving forward, especially if they need to raise more capital or make future acquisitions. On top of that, the company had to do some housekeeping around its financial position to make sure it could keep moving forward smoothly. Marblegate issued a promissory note for up to $485,000 to Marblegate Special Opportunities Master Fund, LP, to cover working capital expenses. And interestingly enough, there's no interest on this loan, which is great in terms of reducing the financial burden. But it also comes with a conversion option, allowing the fund to convert up to $250,000 into shares at $10 each. If you're an investor, this means there's an opportunity to get a piece of the company at a very attractive price, which could be a signal that the company is preparing for some growth ahead. But let's not forget the clock is ticking. Marblegate needed to get approval for an extension on its NASDAQ listing, and it successfully secured that, giving them until March 31, 2025, to finalize the merger with De Palma. That extension gives them a bit more runway to complete the business combination and avoid getting delisted, so it's definitely a critical piece of the puzzle for the company as it moves forward. Now let's talk about how the market has been reacting to all of this. Marblegate's stock has been on a bit of a roller coaster lately. Just a few days ago, on March 28, 2025, the stock saw a huge surge in pre-market trading, going as high as $47.17 per share before closing at $54.37. That's a massive jump from its previous close of $16.26, and it shows there's a lot of excitement and speculation surrounding the company. Part of this could be due to the merger approval and the positive momentum that followed, but it's also worth noting that Marblegate has started to attract the kind of attention that we often see with meme stocks. Investors are watching this closely, and there's a lot of buzz surrounding it. Whether that's good or bad, we'll have to see. For investors, this is where things get a little tricky. On one hand, the approval of the merger is definitely a positive step. If Marblegate can successfully transition from a SPAC to an operational company and start executing on its business plan, that could unlock significant value. The added capital and extension on the NASDAQ listing give it the resources and time it needs to get the deal across the finish line. But on the other hand, the volatility in the stock price is something to keep an eye on. While the excitement and increased trading activity can be seen as a sign of market optimism, it can also be a bit of a double-edged sword, especially when speculative interests start driving the stock price. This is where investors need to be cautious. While there's certainly potential for significant upside if Marblegate can successfully integrate the De Palma entities and execute on its business plans, the speculative nature of the stock right now makes it a bit more unpredictable. If you're considering investing, it's crucial to keep an eye on a few key things. First, how smoothly the merger goes. Will the De Palma companies be a good fit for Marblegate's long-term strategy? Can Marblegate successfully transition into a real operating company and make the most of its new structure? Second, keep an eye on financial developments. How will the company handle its capital needs going forward, and how will the promissory notes and other financing moves play out? And of course, we can't ignore the broader SPAC market. SPACs have had a bit of a mixed track record over the last couple of years. Some have found great success, but others have struggled to live up to expectations. For Marblegate, this means that while there's potential, it's not a done deal. The company has to execute, and it has to do so in a market that's becoming increasingly selective about which SPACs it's willing to back. At the end of the day, Marblegate Acquisition Corporation is at a turning point. It's got a new lease on life thanks to the merger approval, a stronger capital position, and an extended timeline to close the deal. But investors need to stay sharp. The speculative nature of the stock, combined with the inherent risks of executing a successful merger and transition, means that this is a story that's still unfolding. If you're watching Marblegate, stay tuned. The next few months will be crucial in determining whether the excitement around this SPAC will translate into real, lasting value for shareholders. OSR Holdings Incorporated is a global healthcare company that's really putting its focus on improving healthcare outcomes and enhancing the quality of life for individuals and their families. If you're an investor or even just someone keeping tabs on the healthcare space, this company has definitely been making moves worth paying attention to. Their portfolio is wide-reaching with operations spanning from oral immunotherapies for cancer treatment to design-augmented biologics for degenerative diseases, and even expanding into the neurovascular intervention space in South Korea. And when we talk about global operations, we're not just talking about a company dabbling in a few regions. They have a presence in the United States, Europe, and South Korea. So, they're really trying to build something that has the potential for global impact. Now, when you look at OSR Holdings and its subsidiaries, you get a clear sense that the company is taking a multifaceted approach to healthcare innovation. At the core of their strategy are three key areas: oral immunotherapies for cancer, biologics targeting age-related diseases, and the distribution of neurovascular intervention medical devices and systems in South Korea. These are all massive sectors within healthcare, and OSR is making sure it's planted firmly in each one, with an eye toward creating transformative therapies and solutions. But let's zoom in a bit because recent developments with the company have really started to put a spotlight on its next steps, and there's been a lot happening that could have some significant implications for OSR Holdings and its investors. So if you've been watching the company or considering getting involved, this is a pivotal time to understand where things stand. First, we need to talk about the company's move into the oral immunotherapy space for cancer. This is one of their most promising areas of development, as immunotherapies have been gaining a lot of traction in oncology treatment. OSR has been focused on building out its pipeline in this space, and it seems to be making some significant strides. Just recently, they've ramped up their preclinical studies for a new oral immunotherapy aimed at boosting the body's immune response to cancer cells. We know that oral immunotherapies have the potential to revolutionize cancer treatment by offering patients a more convenient alternative to traditional intravenous therapies. If OSR can successfully bring this therapy to market, it could give them a strong competitive edge, especially given the growing demand for patient-friendly, less invasive treatment options. But of course, the process isn't without its challenges. Clinical trials, regulatory hurdles, and the broader competitive landscape in cancer treatment all present risks. But if OSR can navigate these obstacles, the upside could be substantial. On the biologics side, OSR has been making some bold moves as well. The company is developing design-augmented biologics that aim to treat age-related and other degenerative diseases, which is another huge market opportunity. As we continue to see an aging population globally, there's an increasing demand for treatments targeting these kinds of conditions, everything from arthritis to neurodegenerative diseases like Alzheimer's. OSR has a couple of promising biologic candidates in their pipeline, with ongoing trials focusing on enhancing cellular repair mechanisms. This area is incredibly hot right now, with a number of biotech companies targeting age-related diseases, but OSR seems to be positioning itself as a leader by focusing on both the science and the design of its biologics. If these therapies can prove effective in clinical trials, we could be looking at a company with the ability to tap into one of the largest, most growing segments in the healthcare market. Now, while these areas are exciting, let's not forget about OSR's medical device operations in South Korea. This part of the business is an interesting play because as it stands, OSR is distributing neurovascular intervention devices in the Korean market. This includes devices designed for minimally invasive procedures related to treating brain conditions such as stroke or aneurysms. South Korea's healthcare market is sophisticated and growing, and OSR is positioning itself to capitalize on this by establishing strong distribution channels. In fact, the company has been expanding its presence in South Korea through strategic partnerships and distribution agreements, aiming to bring more innovative medical devices to a market that is increasingly looking for cutting-edge healthcare solutions. The long-term potential here is significant, especially as neurovascular intervention is becoming a larger area of focus globally, with increasing awareness and investment in brain health and stroke treatment. However, just because OSR is positioned in these high-growth, high-potential markets doesn't mean it's all smooth sailing. The company's recent financial performance has raised some concerns, and this is something investors need to be aware of. While OSR has been making strides in building out its pipeline and expanding its operations, it has yet to bring any of its major therapies or devices to market at scale. Without substantial revenue-generating products, OSR has been reliant on outside funding and investment, which can put pressure on its operations. In particular, the biotech and medical device markets are capital-intensive, with clinical trials, R&D, and regulatory processes requiring significant investment. But here's the thing. OSR has been actively working to address these financial challenges. In the past quarter, the company secured a sizable round of funding from institutional investors, which will allow them to accelerate their clinical trials and product development. This funding is crucial because it provides a runway OSR needs to prove its concepts and, ideally, bring some of its therapies and devices to market in the next few years. Additionally, the company is in talks with strategic partners to potentially license some of its therapies or devices, which could bring in more capital and reduce the financial strain. While the company has a solid pipeline, how quickly they can bring these products to market will be a major factor in whether they can reach sustainable profitability. And speaking of partnerships, that's another area where OSR has been showing promise. The company has been in discussions with potential pharmaceutical and medical device partners who could help propel their products forward. Partnering with established players in the healthcare industry could provide OSR with the expertise, resources, and distribution networks it needs to move more quickly through the regulatory process and eventually bring products to market. If these partnerships come to fruition, they could be key to OSR's long-term success, especially as it tries to scale its operations beyond its current scope. In terms of the broader market and industry trends, OSR is operating in a favorable environment for growth. The healthcare sector, particularly in the areas of cancer immunotherapy, age-related diseases, and neurovascular interventions, is seeing increased investment. There's a growing focus on personalized medicine, and healthcare systems worldwide are increasingly looking for innovative, cost-effective solutions that can improve patient outcomes. So OSR is in the right space, but execution will be everything. If the company can continue to make progress in its trials, build out its distribution networks, and secure the necessary partnerships, OSR has the potential to become a major player in multiple high-growth healthcare sectors. So for investors, the big question is, how will OSR perform in the coming months and years? The potential is clearly there, but with the current reliance on external funding and the challenge of turning preclinical and clinical candidates into marketable products, the road ahead is not without its risks. It's going to be crucial to see how the company progresses through its trials, how effectively it can manage its finances, and whether it can secure the right partnerships to help scale its operations. In conclusion, OSR Holdings Incorporated is a company that's definitely worth keeping an eye on. They've got a strong and diverse pipeline with the potential to make a significant impact in healthcare, particularly in the areas of cancer treatment, age-related diseases, and neurovascular intervention. But like any company in the biotech space, execution will be key. If they can deliver on their promise, the rewards could be substantial. However, if the financial challenges and the long timelines of development become too much, it could pose risks for investors. As always, this is one to watch closely, especially as the company continues to make moves toward bringing its innovative therapies and devices to market. Stay tuned, because OSR's journey is just getting started, and there's plenty more to come. Let's dive deep into the world of Tenon Medical Incorporated, because this company is carving out a distinct niche in the medical device space with a highly specialized focus on the sacroiliac SI joint fusion market. As an investor, it's crucial to understand not just the technology they're developing, but the potential market opportunity and how recent developments are setting Tenon up for future growth. First off, Tenon Medical is a medical device company that's gained attention for its breakthrough in the field of spine surgery, specifically with its catamaran SI joint fusion system. For those who aren't as familiar with the SI joint, this is a critical joint that connects the sacrum, the base of your spine, with the ilium, part of the pelvis. Over time, or due to trauma or disease, this joint can become dysfunctional, causing severe pain and making even simple movements incredibly difficult. For patients suffering from this kind of pain, a surgical fusion of the SI joint can offer lasting relief, and that's where Tenon Medical's innovation comes in. The Catamaran SI joint fusion system offers a much-needed alternative to traditional SI joint fusion procedures. Traditionally, these surgeries have been invasive and complex, often requiring long recovery times and carrying risks due to the proximity of critical neural and vascular structures in the pelvis. But Tenon's system is designed to change that with a less invasive approach, using a single robust titanium implant. The key feature here is the catamaran fixation device, which passes through both the axial and sagittal planes of the ilium and sacrum. This unique design allows the device to stabilize and transfix the SI joint along its longitudinal axis. What makes this so special? Well, the device's trajectory and angle are designed to avoid critical neural and vascular structures, something that's always a huge concern in spine surgery. The system targets the strongest cortical bone, providing a more secure placement for the implant, which is critical for long-term stability. The primary goal here is to resist vertical shear and rotation in the joint, essentially preventing the SI joint from moving in ways it shouldn't, which is essential for the eventual fusion process. This innovation is significant because it addresses a couple of key issues with traditional SI joint fusion techniques. First, it reduces the risk of complications such as nerve damage or excessive bleeding by avoiding these sensitive areas. Second, the catamaran system's less invasive design could mean faster recovery times for patients, which is a huge plus in the world of spine surgery. Faster recovery is not only beneficial for patients, but also for hospitals and surgical centers looking to streamline operations and improve patient outcomes. So, what does this mean for investors? Well, the SI joint fusion market is growing, and it's poised for continued expansion. The demand for SI joint fusion procedures is increasing as more patients with degenerative diseases, trauma, or conditions like arthritis seek relief. There's a gap in the market for procedures that are both effective and minimally invasive, and Tenon Medical is filling that gap with its catamaran system. With a relatively small number of competitors in this space, Tenon has the potential to capture significant market share if it can scale production, secure regulatory approvals, and generate adoption within the medical community. In terms of regulatory progress, Tenon has already received FDA clearance for its catamaran SI joint fusion system, which is a major milestone for any medical device company. Regulatory approval is one of the most significant hurdles for medical device manufacturers, and the fact that Tenon has cleared this major checkpoint signals that the company is on track to start bringing its product to market on a larger scale. This is where things start to get interesting because FDA approval opens the door for broader commercial sales, meaning that Tenon's next big challenge will be to get the system into the hands of surgeons and hospitals. This is where marketing, education, and clinical evidence come into play. Speaking of clinical evidence, Tenon is not just relying on the device's approval to drive sales. They've developed a proprietary two-dimensional, 2D, placement protocol that ensures proper positioning of the catamaran fixation device, enhancing the precision of the procedure. This protocol is a key selling point for hospitals and surgical centers as it promises better outcomes and fewer complications. Additionally, Tenon has developed a protocol for three-dimensional, 3D navigation, leveraging the latest techniques in spine surgery. The 3D navigation system adds another layer of precision to the procedure, helping surgeons place the implant with even greater accuracy. The more precise the placement, the better the fusion, and the faster the recovery. This is a key differentiator for Tenon, as it gives the system an edge in an increasingly competitive market. But of course, with all this potential, there are risks and challenges that come with it. First, Tenon still needs to prove that the system can scale effectively. While the technology is impressive and the FDA approval is a significant hurdle to overcome, scaling production and getting widespread adoption will take time. There are costs involved in manufacturing and distributing the system, and Tenon will need to ensure they have the infrastructure in place to meet demand. They'll also have to navigate the dynamics of selling to hospitals and surgery centers, which often involve lengthy decision-making processes and high barriers to entry. In addition, Tenon will need to work hard to build clinical evidence that demonstrates the superiority of its system over traditional methods. The medical device market is highly competitive, and hospitals are often reluctant to adopt new technologies unless there's solid proof that it delivers better outcomes. Therefore, Tenon will likely need to conduct more clinical trials to gather the kind of data that will persuade surgeons and medical institutions to choose the Catamaran system over other alternatives. Fortunately, the company has already shown a commitment to gathering clinical evidence, and if their data supports the claims of faster recovery times and fewer complications, they could see a significant uptick in adoption. Now, let's talk about the broader market dynamics. The market for spine surgeries, and particularly SI joint fusion procedures, is growing steadily. The aging population, an increase in degenerative diseases, and the rising awareness of minimally invasive procedures are all contributing factors. Patients are increasingly looking for alternatives that offer less pain, shorter recovery times, and lower risks, and Tenon's less invasive approach to SI joint fusion is well positioned to take advantage of this trend. The opportunity is there, but Tenon will need to move quickly to establish itself as a leader in this space before competitors catch up. There's also the issue of reimbursement. In the medical device industry, having a product that's reimbursed by insurance companies is critical to widespread adoption. Tenon will need to work closely with payers to ensure that their Catamaran system is covered under insurance plans, making it accessible to a larger patient base. Without reimbursement, even the best technologies can struggle to gain traction in the market. So, what's the takeaway for investors? Tenon Medical Incorporated is in an exciting space with a potentially game-changing product. The Catamaran SI joint fusion system addresses a real need in the market, offering a safer, less invasive alternative to traditional SI joint fusion surgeries. The FDA approval is a major milestone, and the company's focus on precision with its 2D and 3D placement protocols gives it an edge in the market. However, scaling production, proving the system's effectiveness in clinical settings, and gaining widespread adoption will be the next big hurdles. Investors should watch for developments in clinical data, adoption rates among surgeons, and how well Tenon navigates the regulatory and reimbursement landscapes. There's a lot of upside potential here, but as with any medical device company, execution will be key. Let's take a deep dive into MicroAlgo Inc, a company that has been making some waves in the technology sector with its innovative approach to central processing algorithms. For those of you keeping track of cutting-edge tech developments and the companies that are pushing the boundaries of what's possible, MicroAlgo is a name to watch. This holding company specializes in the development and application of bespoke central processing algorithms, offering tailored solutions to enhance computational efficiency across various industries. But it's not just about creating algorithms. It's about how they're applied, integrated, and optimized to make systems work faster, smarter, and more efficiently. So what exactly does MicroAlgo do? The company is focused on providing comprehensive solutions by integrating central processing algorithms with both software and hardware. This integration allows their clients to accelerate computing power without needing to make expensive hardware upgrades. In an industry where technology is evolving at breakneck speed, the ability to enhance computing power and optimize data processing without investing in new hardware is a game changer for businesses. This is a massive selling point for companies across a variety of sectors looking to remain competitive and efficient while keeping costs in check. One of the standout features of MicroAlgo's services is their lightweight data processing and data intelligence solutions. Essentially, this means that the company specializes in creating algorithms that can process large amounts of data efficiently using minimal computational resources. This is crucial for industries that rely on handling vast quantities of data in real time, such as internet advertising, gaming, and intelligent chip design. Whether it's optimizing ad targeting algorithms, improving gaming experiences, or refining the performance of electronics, MicroAlgo solutions are designed to keep systems running smoothly and at peak performance without straining resources. The company operates in two primary segments: central processing algorithm services and intelligent chips and services. The first segment, Central Processing Algorithm Services, is where MicroAlgo has carved out a strong niche. It's not just about developing algorithms, it's about tailoring them to the specific needs of enterprise customers in various industries. And when you look at the three main verticals MicroAlgo serves, internet advertising, gaming, and intelligent chips, it's clear that the company is targeting industries that are not just large, but are also growing and evolving rapidly. For example, let's talk about the internet advertising sector. MicroAlgo provides algorithm optimization services to advertisement integration agencies. These agencies rely heavily on algorithms to analyze and target consumer behavior in real time, ensuring that ads reach the right audience at the right time. The company's ability to optimize these algorithms, improving targeting accuracy and efficiency, is a key differentiator in the highly competitive world of digital advertising. Given how critical data-driven decisions are in this space, MicroAlgo is in a strong position to benefit as demand for more effective and efficient ad algorithms continues to rise. Then, there's the gaming industry, which has been undergoing significant growth, especially with the increasing popularity of mobile and online gaming. Game developers and distributors are always looking for ways to enhance the gaming experience by improving the speed, performance, and scalability of their platforms. MicroAlgo's bespoke central processing algorithms are designed to optimize game performance, making sure that the games run smoothly even with complex real-time interactions, high-resolution graphics, and heavy user traffic. This kind of optimization can be a huge selling point for developers looking to stay ahead of the curve, and it's a major reason why MicroAlgo's solutions are gaining traction in the gaming sector. The third major vertical for MicroAlgo is intelligent chips, which ties into their second business segment, intelligent chips and services. The company provides algorithmic solutions for chip designers and integrators, helping them optimize the performance of their chips. In a world where the demand for more powerful and efficient chips is only growing, especially with the rise of AI, machine learning, and Internet of Things (IoT) applications, MicroAlgo's ability to fine-tune chip performance without the need for physical hardware upgrades is a major advantage. The chip sector is increasingly focused on creating specialized chips that are faster and more efficient, and MicroAlgo's contributions to this space could make a significant impact as companies race to develop the next generation of technology. But let's zoom out a bit and talk about why MicroAlgo's business model and offerings are so timely. The demand for more efficient computing solutions is an all-time high. As industries like gaming, advertising, and electronics continue to innovate, the need for advanced algorithms to manage and optimize data processing will only grow. One of the key catalysts for MicroAlgo's growth is the increasing need for companies to maximize the performance of their existing hardware without constantly upgrading to the latest and greatest technology. In a world where data is king and processing power is everything, being able to get more out of your current infrastructure is a huge advantage. MicroAlgo is tapping into this demand by offering solutions that help businesses do exactly that. Moreover, the trend toward AI and machine learning in various sectors plays right into MicroAlgo's strengths. Machine learning algorithms, for instance, require vast amounts of data and processing power, and companies are increasingly seeking out ways to make these processes more efficient. MicroAlgo's expertise in algorithm optimization positions it well in this space, particularly as businesses look for ways to implement AI and machine learning at scale without needing to overhaul their entire infrastructure. By providing data intelligence and lightweight processing solutions, MicroAlgo is aligning itself with the growing trend of AI adoption across industries. As far as the company's financials go, it's worth noting that while MicroAlgo has positioned itself well within its target sectors, it's still in the early stages of scaling its operations. The company's ability to grow will depend on its ability to secure long-term contracts and partnerships with enterprise customers, as well as expand its footprint in the gaming, advertising, and intelligent chip markets. Investors should be closely monitoring how effectively MicroAlgo executes on its growth strategy, as the next few quarters will likely reveal how successful it is at penetrating these large and competitive markets. There's also the matter of expanding its customer base. While the company's existing clients, advertising agencies, game developers, and chip manufacturers, are all sizable industries, it will be important for MicroAlgo to diversify its clientele further, potentially expanding into other high-growth sectors such as healthcare, finance, or autonomous vehicles, where data processing and algorithm optimization are critical. The versatility of MicroAlgo's technology makes this a very real possibility, and its ability to adapt to new industries will be key to driving long-term growth. On the flip side, there are a few risks to keep in mind. The company operates in highly competitive markets where both established players and emerging startups are vying for market share. While MicroAlgo's bespoke solutions provide a clear value proposition, the pace of technological advancement in algorithm development and chip design means that constant innovation is required. MicroAlgo's success will depend not only on its ability to stay ahead of the curve, but also on its capacity to differentiate itself in a crowded market. Additionally, there's the matter of scalability. As the company expands its reach and looks to integrate its solutions with more hardware and software systems, it will need to ensure that it can scale its operations effectively without compromising the quality of its solutions. This could involve ramping up production, hiring more talent, or even forming strategic partnerships to help accelerate growth. In conclusion, MicroAlgo Incorporated is a company that's sitting at the intersection of two massive trends: the increasing demand for more efficient computing and the explosion of data-driven industries. The company's bespoke central processing algorithms are well-positioned to address the needs of industries like internet advertising, gaming, and intelligent chip manufacturing. With a solid product offering and a clear market opportunity, MicroAlgo is on track to make a significant impact. However, the road ahead won't be without challenges. Investors should keep an eye on how the company scales its operations, attracts new clients, and navigates the competitive landscape. The potential is there, but execution will be the key to MicroAlgo's success in the coming years. It's a company that could very well be poised for growth, and it's one to watch closely as it continues to expand its footprint in the tech world. Thanks for tuning in, and I am definitely looking forward to our deep dive of what next 5 spectacular number 1 daily stocks will be. New episode will drop every Sundays, so subscribe to get notified when it releases. Until then, check out our podcast playlist to catch up on previous episodes. Thanks.